Hello traders, Gary Wagner here, just after 9 o'clock in Honolulu, 3 o'clock in New York. It is Tuesday, the 19th day of August 2014, and this is the daily report for gold and silver. Across the board, we do have lower metals prices, moderately lower on the day. We do have a strong U.S. dollar and an equities market that is trading higher. First to gold, currently trading off about $2 on the day, $12.95 and change is what you see on the screen, with a low of $93.40 and a high of $13.0340. Silver, also trading lower on the day, trading off about 18 cents actually. Current print on the screen, 1942. You can see this low at 1930, high 1980. We will definitely talk about silver towards the end of the show, as it has gone to the price we were looking for last week. As I said, if it broke through 1978, it had nowhere to go but 1935. And obviously, when we look at this low today, that's exactly what has transpired. So, first to gold, and I want to look at it in a couple of different ways this morning. This is a short-term chart, half-a-day chart. It is in Japanese average format, so we're not really looking at any of the candlestick patterns. What I'm trying to do is to get a sense out of really a wave count, and what I found is that by looking at the Japanese average charts, when we're doing our Elliott wave, we usually get a clear distinction of the dynamics in terms of when a market hits a dynamic bottom, pivots off that bottom, and then moves up. You can see that here. This is our A. Our B, of course, is really this compression triangle. And when we look at it through the eyes of a 720-minute chart, it really becomes very, very clear as the market moves up. We have, these are called legs. What you get in this type of a breakout is you're looking for a series of 5 legs. So you get 1, 2, 3, 4, 5, and then a slow move to the apex, and then it breaks down. So we do get our 5 count in terms of the wave count itself. You might start the wave count from here, and then you would just get exactly 5. But you also see that here in this wave 1, where we had this move up, we had the correction, it goes red. And then up here, of course, we could look for some kind of a wave count, a sub count in there. But to me, that's not as important as lining up a particular wave count. In other words, looking for a certain area and then looking for that color change. Now, the reason that I bring that to your attention, we did exit a trade. We exited that trade with very, very small profits. And it's my sense right now that this latest correction that we're experiencing right in here is really just in terms of a subcounter corrective wave. That is only relative and accurate if we maintain above this 1280. That's our 61% retracement. And so if I look at it in that way, the 61% retracement here is accurate, and then this is our 76% retracement, which is 1290. Now, I do have another chart, time permitting, we'll put it up, but it really only looks at one particular Elliott wave count, or excuse me, Fibonacci, and that is it takes this particular rally here, and then what we look for is a sell-off here, and that's this 76% retracement right in here at 1290. So 1290, 1292, as I said on yesterday's show, I believe is a very, very critical point that the market really needs to hold if our model is going to really stay intact and we don't have to work with it, maybe change it a little bit. It's still providing us with good, accurate information. So I've gone ahead and I have pulled up a daily chart. This is of COMEX Gold. And when we do that, what we can really see in terms of the candlestick types that we're getting here, we are getting a continuation of this downward move that we've seen recently. These are 3 down days in a row, smaller body, and for that reason, I would look to see if we can find some support come into the market around 1290. Now, when we go ahead and convert or look at our Japanese average chart, our daily chart, what we are seeing is the downtrend is still fully intact. Realize that on a Japanese average, it's always going to lag behind any of the other indicators and technical studies that we use because it's average based, but body size is still fairly strong. It compares it to the midpoint of the prior day. And we do have the absence of these upper wicks, which is what we look for to determine that a downtrend is still intact. As I said, I would look for some support to come into this market roughly at 1290. It's also a critical area because if it breaks below there, traders, then we're not looking at a simple correction anymore, and we have to really go back to the drawing board. So in terms of looking at the market from the perspective of whether or not we have seen any long-term damage or major damage in the market, I really want to take a look at this 2-day chart. And the 2-day chart, really what's important here is our Andrews pitchfork. And this shows the dynamic breakout that we did get finally over these cascading channels that moved down. We can see that when we had our first correction, it never violated or went into that zero prong. Market moves up a little bit, and as it's come down, it is trading well above this particular cascading channel line. As I said, if we start to get a dynamic uptrend, which really moves into place, then we'll actually be able to, for the first time in a couple of years, go ahead and plot a positive or a bullish Andrews pitchfork, which would have a cascading channel to the upside, as opposed to this long-standing channel line that cascades in a bearish mode. And traders, finally, I want to look at a daily chart spot market. And I've got a couple of different fib retracement levels. This is where I drew the 92, 1292, 92, almost 93. And so my sense is that this is an area that we need to see as a supportive area in the market. When we look historically, we can see that at points it acted absolutely as support. When it broke through that and it became resistance, our new support level became the secondary low at 1280. And look at the dynamics of how it breaks through this former resistance. And I believe at this point, now it will become a supportive area. Again, we did exit a long position. We are currently flat in gold. My suggestion is to remain flat and to wait for some sort of a signal, because my sense is we could be close to the conclusion of this small minor corrective wave. Now, if that does occur, at the same time as we look at silver, we are wanting to check to see if we find any support at 1935. You notice in terms of the one fib retracement that I have in here, that's really the last stand, so to speak, because a market that breaks below a 76% retracement can no longer be really analyzed or viewed as in a simple or a defined correction, because a defined correction that goes beyond that is a lot more than a correction. It's actually a change in trend and a return to the opposite trend, whether it's 76 on the upside or downside. So we're going to sideline on silver. We're going to see if it finds support. Gold, as I said, I believe that we have the numbers we want to look at, and we will take it from there. This has been Gary Wagner, wishing you, as always, good trading. Talk to you tomorrow on Wednesday for another daily update and review. Bye-bye.